Welcome to the first lesson of our Fundamentals of Options Trading course. In this lesson, we'll be learning about options basics. Here is the outline for this lesson. There are thumbnails in the video description, so if you would like to jump ahead to a particular section, feel free to do so. Let's begin with understanding what a financial option is. It is essentially a contract between a buyer and a seller. At the start of the contract, the buyer needs to purchase the product from the seller by paying what's called the option premium. So this is the price the buyer pays. In return, the option seller writes the contract and provides it to the buyer. The contract will always involve something called an underlying asset. This can be pretty much any asset, but most often it is a stock. So we'll be mainly talking about stock options. And the key characteristic of an option contract is that it gives the buyer the right, but not the obligation to exercise the contract. Okay? This is important, so this gives the buyer flexibility. So option contracts are only exercised if they are profitable for the buyers. And for that reason, these are valuable contracts. And of course, the sellers, so these are the option writers, they won't provide these products for free. So that's why they charge the option premium. Okay. Now let's learn a bit more about the key terminology involved in option contracts. So every option contract will specify an expiration date. So for example, this could be a month, so like 30 days. It will specify the option premium. So this is the price the buyer pays to the option writer. And it will involve what's called a strike price, or it's also known as the exercise price, right? So this is the price at which the contract can be executed. So in the case of a stock option, so for example, say you have an option contract on Amazon shares. If the exercise price is $10, this means that the stock can be, the option contract can be executed at this price, regardless of what the current price of Amazon shares is in the market. Now, there are two main types of option contracts. One type is called call. Essentially, this gives the option holder the right to purchase the asset. Okay, so the call option gives you the right to purchase Amazon shares, whereas a put option gives you the right, but not the obligation, to sell them. Okay, so call is a right to buy, and put is a right to sell. Okay. Another important distinction is between American options versus European options. American options are more flexible in the sense that you can exercise them anytime until the expiration date. So if it is 30 days, if you wanted, you could, once the contract is written and purchased, you can exercise the next day, in 10 days, whenever you like, right, until the expiration. Whereas European contracts are less flexible in the sense that they can be only executed or exercised on the expiration date. So they can't be exercised before expiry. Okay? American options have this added flexibility, and that's why they are typically more costly to purchase, right? So the option premiums for American options would be higher than equivalent European counterparts because of this added flexibility. Finally, we can also make a distinction between the long position in a call option or in an option contract in general versus a short option. And the idea is the same as in a long position in a stock versus a short position. So if you are the buyer of the option, so if you are the option holder, right, you have a long position, whereas if you have the option writer, you have a short position. So the buyer and the holder have the long position, the writer and the seller, they have the short position. Now, why would we purchase options? There are two broad reasons in general. The first one is speculation, right? So, for example, you are interested this time in Tesla shares, and you believe that, for example, Tesla shares will gain in value. So let's say they're at the moment $10, and you expect that maybe they will increase to $20 in a couple of months. One thing you could do is you could, of course, purchase Tesla shares, right? But that might be risky because if you are wrong, right, if the share price actually goes down to $5 rather than increasing to 20, you will be losing money, right? So your portfolio would become less valuable. A safer scenario is to use a call option in this case, right? So you can pay for a call option at a strike price of, let's say, $10. And if indeed you are correct about your belief, and if the price goes up to 20, then you basically exercise your call option and pocket in the difference between these two values as your profit. But if you are wrong, you don't lose the money. The only thing you lose is actually the price you paid to purchase the option, because now, because the stock lost value, you actually won't exercise your call option, right? Remember, you have the right, but not the obligation. The second main reason for purchasing options is hedging. And think of it as insurance, okay? Let's again think of Tesla shares, and let's suppose this time you actually own a large number of Tesla shares. And again, let's say the current price is 10, but now this time you are worried that these shares will indeed lose value and maybe go down to $5 in the coming months. So to reduce your risk, right, of this drop in value, you can purchase downside protection via put options, right? So basically, call contracts provide upside potential, and put options provide downside protection. So you could purchase put options with a strike price of $10, and if indeed you are right about your worry and the price drops substantially, instead of selling your shares in the open market for $5, you could sell them for $10. So you protect the value of your holdings. All right. Next, we will look at the option payoffs at expiry with in more detail, and we will begin with the long position. So this time we are focusing on the option holder, and in the next slide we will look at the short position. And for simplicity, let's say we are focusing on European options, so which can only be exercised on the day of expiry. And let's see how the payoffs would look like as a function of the stock price, and we will consider call options and put options separately. So let's begin with call options. Remember, these options give you the right but not the obligation to buy the underlying asset. Now, our payoff will be a function of stock price, and the payoff schedule will look like this. So this point is important. So this is the strike price, okay, strike price or exercise price. Let's call this K dollars, okay? Let's call the stock price P dollars. So what this payoff schedule tells me is that if at the expiry stock price is less than strike price, so if I'm in this region, I actually won't exercise my option and my payoff will be 0. Why? Let's again think that this is $10, and let's say the stock price ends up being $5. Okay. So now it doesn't make sense to exercise this call option. Why? Because why would I pay $10 according to the contract to buy shares if in the market they're only worth $5? Right? So it doesn't make sense. But it starts making sense if the stock price exceeds the strike price at expiry. So for example, on the expiry date, let's say the stock price is 15. Now, the market price, right? So if contractually, if I can purchase them for $10, this is great, because I can immediately, if I wanted to, sell them in the open market for $15, and that would imply a net payoff of $5 per share, right? So I can write the call option at expiry as the maximum of $0, the case where I don't exercise, so this region on the left-hand side below the strike price. Or in the better scenario for me, if the stock price exceeds the strike price, my payoff is the difference between the two. So this is the call option payoff at the expiry. Let's contrast this with the put options, and we will sort of have a mirror image, right? So let's say we have now put options, and remember, these options give you the right but not the obligation to sell. Now the payoff schedule looks like this, right? Again, this is the strike price. So let's say again, this is $10. Now, this put option is not valuable, and I'm not going to exercise it if the stock price exceeds the strike price at the expiry. Let's see why. If, for example, the market price is $15, why would I sell my shares at the strike price for $10 while I could sell them in the open market for $15, right? It doesn't make sense to exercise. So again, for the put option, the payoff will be either 0, okay, so which if I'm in this region, or it will have a positive payoff if the stock price indeed declines. For example, if it drops to $5, then my net payoff is $5. Why? The market value is 5, whereas I could sell these shares for $10, right? So the difference is a profit or a payoff of $5. So in this case, it is the difference between the strike price minus the stock price. So as the option holder, basically, for example, if I'm buying a call option, in the end, I hope to be in this region, right? Because this is where I make a profit. If I end up in this flat region, essentially, I paid for this contract but didn't exercise it, which is not great. Similarly, for the put option, I would like to be here where my payoff is positive. I don't want to be here because if I'm here, basically, I paid for a contract that I didn't exercise in the end. With that in mind, let's look at now the payoffs for the short position. And this will be the counterpart of the long positions, right? So when the long position makes a profit, essentially the short position is making a loss, and vice versa. Okay, so let's again consider call options and put options separately. So let's begin with call options. Okay, from the sellers, the option writers' perspective. So from their perspective, they want to be here, right? Because here the option holder doesn't exercise the option, right? So this is again the exercise price. Let's say K dollars. So in this region, the option seller, right, or the option writer, they received the option premium and they didn't have honor the contract because it hasn't been exercised. And from the writer's perspective, they don't want to be in this region. Because, for example, if this is $10, if this is $15, that $5 profit the owner is making is a $5 profit loss for the option seller. Okay, and the risk with being a call option seller is that your potential losses are unlimited. So, for example, if the stock price suddenly jumps to $50, you are then going to be making a loss of $45 per share. Okay, so theoretically, this can go to infinity. Right? Similar scenario with put options, but the good thing with the put options from the seller's perspective is that potential losses are kept. So let's try to understand it again. So again, here we have a strike price of $10, let's say. So this is the region the seller wants to be, because this is the region where the other party, the buyer, doesn't exercise the contract, right? But if the stock price ends up, let's say, $5, now this is valuable for the buyer. They will exercise it, and the seller will realize a loss of $5 per share. The worst that can happen to the underlying stock is that it could go worthless, let's say all the way down to zero. And in this case, the loss of the option seller is kept at 10, right? Because basically they have promised to purchase this stock from the buyer at the strike price, which is $10. So they are paying $10 for something that is worth nothing in the market, right? So this is a loss of $10 per share. But the loss per share will never be higher than the strike price, because the worst that can happen to the stock is that, it becomes worthless. So here is some homework for you. Okay, so there are a couple of true or false questions. And if you go to the video description, you can find a link to the solutions for these questions. I hope you have enjoyed this video. In the next lesson, we'll be covering option moneyness, and I'm looking forward to see you in that lesson as well. And that's it for today. Thank you for watching.